It all began when President Donald Trump announced sweeping new tariffs on all Chinese imports. Yes, you heard that right, all Chinese imports. A 10% levy across the board, justified under the banner of protecting American jobs, correcting trade imbalances, and safeguarding national security. At face value, some investors cheered. After all, a tough stance on China is often perceived as pro-America first. The dollar even initially strengthened against the yuan and other global currencies. It seemed like just another chapter in Trump's America First economic playbook. But what happened next? Markets took a turn, and not a gentle one. It became immediately apparent that China wouldn't take this lying down. The prospect of retaliatory tariffs meant that American exports were now in jeopardy. Investors began to anticipate a full-blown trade war, not unlike the situation we saw during Trump's first term. And that anticipation sent a chill down Wall Street's spine. The S&P 500 futures dipped, and the Dow Jones Industrial Average showed early signs of stress. Market participants started reallocating capital quickly. Safe haven assets like gold surged, while Treasury bonds, once the benchmark of safety, started selling off rapidly. This wasn't just a stock market tantrum. This was a signal that investors had lost faith in short-term stability. In this first chapter, we're seeing a classic case of political policy hitting financial panic. When a single move from a president can rattle global confidence, it begs a larger question. What's the cost of unpredictability in leadership? The immediate sell-off wasn't just about tariffs. It was about uncertainty. Because as seasoned investors know, markets can handle bad news better than they can handle not knowing what's next. So why were treasuries selling off? Why did the dollar weaken after that initial jump? In simple terms, investors feared that China might start offloading U.S. government debt, a nuclear option, but one that always lurks in the background during these standoffs. The U.S. relies heavily on foreign buyers, especially China, to purchase treasury bonds. If China signals even a modest reduction in buying, it spooks bondholders, increases yields, and weakens the bond's resale value. As yields rise due to bond sell-offs, borrowing costs go up, not just for the government but for businesses and consumers. Mortgages, car loans, credit cards, they all get pricier. That's the real danger, and that's what had investors on edge. This is how a political policy starts to ripple out into real economic consequences. Stay tuned, because in part 2, we'll break down China's retaliation, the hedge fund squeeze, and how global markets plunged into chaos overnight. The world didn't have to wait long for China's response. Within 24 hours, Beijing announced a set of counter-tariffs targeting $120 billion worth of U.S. goods, focusing heavily on agricultural products, tech components, and critical industrial imports. It was strategic, designed not only to match Trump's aggression but to hit at the heart of red state America, where many farmers and manufacturers form Trump's political base. The message was clear: we can play this game too. Markets felt it instantly. Asian indexes plunged overnight. The Nikkei dropped more than 3%, Hong Kong's Hang Seng took a beating, and U.S. pre-market futures turned red across the board. But it wasn't just about equities, bond markets started shaking as well. Here's the kicker: China didn't just stop with tariffs. Rumors began swirling that Beijing was reducing its purchases of U.S. Treasury bonds. A few key analysts pointed to auction data and bond desk activity that showed unusual silence from Chinese buyers in recent 10-year and 30-year Treasury auctions. For big institutional players, hedge funds in particular, this was a red alert. Many had long positions on bonds, assuming the Fed would keep rates steady and the U.S. would remain a safe haven for global capital. Suddenly, they were caught in a storm. As China stepped back, yields on treasuries surged, crossing the 4.5% mark on the 10-year and threatening the psychologically crucial 5% level. This caused what we call a hedge fund squeeze, forced selling of bonds as prices dropped, triggering margin calls which led to more selling. A domino effect. Several funds that had relied on high leverage, borrowing billions to play the long-duration bond trade, faced massive mark-to-market losses. Bloomberg later reported that at least 2 prominent funds had to unwind positions at a loss of over $1.2 billion. Meanwhile, the US dollar, after spiking briefly against the Chinese yuan, it began to retreat. The DXY dollar index, which measures the dollar against a basket of major currencies, fell below 102 for the first time in months. Why the weakness? Because foreign investors feared U.S. instability. Think about it. If the world's largest economy is heading into a politically motivated trade war, and if one of its biggest creditors is hinting at pulling back, then the dollar's global reserve status, while not threatened directly, begins to lose a bit of shine. This was no ordinary sell-off. It was a crisis of confidence. Let's talk about the bond market, the so-called smart money of finance. When bond prices fall and yields rise dramatically, it's often a sign that investors are pricing in risk of inflation, higher deficits, or instability. This sell-off signaled all three. And the inflation part? That's key. Trump's tariffs are effectively a tax on imports. American companies that rely on Chinese parts or goods now have to pay more, and guess what? Those costs are usually passed on to the consumer. Inflation ticks higher. That puts the Federal Reserve in a bind. The central bank had been cautiously optimistic about cutting rates later this year. But now, with inflation flaring again due to tariffs and global demand potentially cooling from a trade war, the Fed's path just got more complicated. So now we have a storm of trade tensions, bond market chaos, inflation fears, currency weakness, political uncertainty. All this spells volatility, and as any investor knows, volatility is both a danger and an opportunity. Welcome back to Investment Stories. In the first two parts, we saw how President Donald Trump's sweeping China tariffs rattled the bond and currency markets, triggered a hedge fund squeeze, and stirred fears of a global trade war. But now, in part 3, we turn to Main Street and corporate America, because what happens in the markets never stays just in the markets. The ripple effects began in boardrooms. Major U.S. companies with exposure to Chinese supply chains were the first to raise alarm bells. Apple, for instance, issued a statement warning that the new tariffs could increase the cost of manufacturing by as much as 12% per unit on several of its flagship products. That may not sound like much at first glance, but with millions of units, it represents billions in additional costs. Apple's stock fell 6% in a single day, wiping out over $150 billion in market value. But they weren't alone. Retailers like Walmart and Target warned of upcoming price hikes on consumer goods, everything from clothing to electronics to everyday household items. Supply chains built over decades optimized for efficiency and cost-effectiveness were suddenly facing a 10% hit overnight. CEOs across industries from semiconductors to automotive to machinery began slashing their forward earnings guidance. And that's when Wall Street really took notice. Because guidance cuts mean shrinking profits, reduced dividends, and lower capital expenditures, all signs of a potential economic slowdown. Next came job market fears. Several multinational corporations hinted at hiring freezes, and some started talking about layoffs if the tariffs continued. Small and medium-sized manufacturers that depend on Chinese components were especially hard hit. Without the financial cushion that large firms enjoy, many began lobbying Congress for relief. On the consumer front, the inflation hit was becoming visible. Let's break it down. If the cost of imported goods goes up and corporations pass those costs down to shoppers, you get price hikes. And when prices go up but wages stay the same, real disposable income drops. In simple terms, Americans feel poorer even if their paychecks stay the same. This is dangerous in an economy that's 70% driven by consumer spending. And here's where the 2025 presidential race starts entering the conversation. President Trump, now well into his second term, has built his economic pitch around nationalism, bringing jobs home, leveling the playing field, and making America strong again. But the data wasn't cooperating. GDP growth projections for Q2 were revised down from 2.2% to 1.3%. Consumer sentiment as measured by the University of Michigan plunged to a 14-month low. Democratic challengers seized the opportunity. In campaign ads and rallies, they painted Trump's tariffs as taxes on the American middle class, arguing that his policies were hurting farmers, small businesses, and working families. Independent economists echoed that view, noting that tariffs historically act like regressive taxes. They hit the lowest income groups the hardest. Meanwhile, credit card data showed that consumer spending was already slowing in categories like apparel, electronics, and home goods, even as purchases in essentials like groceries and gas held steady. The result? A dual-speed economy, one where the wealthy continued to spend thanks to market rebounds in energy and certain sectors, But middle-class households began pulling back. Retail foot traffic slowed. Online shopping carts were abandoned. Store inventories began to pile up. And then came the whispers of the R-word recession. While most analysts agreed that a full-blown recession wasn't imminent, they did begin forecasting a significant growth slowdown if the trade war continued through Q3 and Q4. Morgan Stanley, JP Morgan, and Goldman Sachs all revised their 2025 growth outlook downward. Welcome back to Investment Stories. In Part 3, we watch corporate America scramble and U.S. consumers tighten their wallets. Now, in Part 4, we dive into the central bank's biggest policy crisis in years and how global investors began pulling their money away from the U.S., altering the future of American capital markets. When chaos erupts in markets, everyone looks to one institution, the Federal Reserve. By the end of the second week after Trump's tariff announcement, all eyes were on Fed Chair Jerome Powell. The Fed had signaled earlier in the year that it might cut interest rates by mid-2025, provided inflation remained tame and the economy didn't overheat. But now? Inflation was rising not from consumer demand but from supply-side shocks, the worst kind of inflation for central bankers. It wasn't being driven by overheating growth but by artificial cost pressures from tariffs and global supply chain dislocations. This is the classic central bank nightmare, what's known as stagflation risk, where the economy slows but inflation still rises. If the Fed cuts rates to support growth, it risks fueling even higher inflation. But if it keeps rates steady or hikes them, it could choke off growth entirely, pushing America into a recession. Powell's tone shifted significantly in his next press conference. Instead of leaning into rate cuts, he adopted what analysts called a hawkish pause, a signal that the Fed would stand pat for now, watching both inflation and trade developments closely. But investors didn't like watch and wait. They wanted action. And when they didn't get it, the U.S. Treasury market saw another wave of selling. Foreign buyers, who traditionally account for more than 40% of Treasury purchases, began pulling out. As the 10-year yield crept above 5%, a symbolic ceiling for many large pension funds and sovereign wealth entities, there was a sense that confidence in U.S. fiscal stability was eroding. Here's the bigger issue: the U.S. government is running a record deficit and the cost of servicing that debt rises as yields go up. So when buyers retreat, the government has to offer higher yields to attract capital, which only compounds the deficit. It's a vicious loop. This retreat of global capital wasn't limited to Treasuries. Foreign direct investment, FDI, began to show signs of weakening. Inflows into U.S. equities slowed sharply. European and Asian pension funds shifted new capital allocations into emerging markets with better growth prospects and less geopolitical risk. In fact, India, Vietnam, and Mexico saw a boost in capital inflows, partly as companies and funds bet on them as alternative manufacturing hubs. The phrase China Plus One, once a niche supply chain strategy, was now being echoed across investment boardrooms worldwide. Back in the U.S., tech companies that relied heavily on Asian manufacturing began looking to relocate facilities to Latin America. But these moves take time. Months, sometimes years. The short-term pain was already being felt. Wall Street banks, for their part, were caught in the crossfire. Bank of America, Goldman Sachs, and Citigroup all issued revised earnings outlooks. Investment banking divisions saw deal pipelines shrink as corporate clients postponed expansion. Capital markets desks saw decreased foreign demand for U.S. IPOs and bonds. Retail investors also got jittery. Mutual fund outflows spiked, especially from bond-heavy portfolios. Gold prices surged past $2,200 per oz, a 15% jump in just a few weeks as investors sought safe havens. Bitcoin also saw a mini-rally, crossing $70,000, fueled by global liquidity looking for insulation from political and economic chaos. The question on every investor's mind was this: is the U.S. still the safest place to park capital? This was unthinkable just 5 years ago. But with political risks rising, trade relationships fracturing, and inflation complicating Fed decisions, the perception of American exceptionalism in global capital markets was under threat. So to summarize Part 4, the Fed was caught between rising inflation and a slowing economy. Treasury yields surged beyond comfort zones. Foreign capital started fleeing U.S. bonds and equities. Emerging markets gained favor. Gold and crypto rallied as safe havens. The dollar wasn't just wobbling, its status as the world's anchor currency was facing questions not from doomsday theorists, but from mainstream global investors. The recent sell-off in U.S. Treasuries and the dollar is more than just a short-term market tantrum. It's a recalibration of global trust in U.S. leadership, in policy predictability, and in long-term financial stability. Let's take a moment to be clear. The U.S. dollar remains the world's dominant reserve currency. Over 58% of global foreign exchange reserves are still held in dollars. No other currency comes close. But for the first time in decades, cracks in that dominance are being exposed, not by revolution but by accumulation. And that's where the investment story turns deeply strategic. Magnifying glass tilted right, a changing global currency landscape. After the tariffs and Trump's anti-China stance reawakened global trade fears, central banks in countries like Brazil, India, Russia, and China began speeding up their efforts to diversify reserves. Some started adding gold. Others shifted small percentages of their holdings into the euro or Chinese yuan. While these currencies don't yet offer the liquidity, transparency, or institutional trust of the dollar, their trajectory matters. It's not about replacing the dollar overnight. It's about reducing dependence on it. That alone can shift how global capital flows and how much economic power the U.S. can wield. For American investors, this means volatility in currency markets could become a semi-permanent feature of the financial landscape. Chart increasing sector winners and losers. Now let's talk money moves. Winners in this environment include commodities, gold, silver, oil. These are tangible assets with value that transcends currency risk. Defense stocks. With geopolitical tension rising, defense budgets are likely to swell. Domestic infrastructure. Companies tied to American construction, manufacturing, and localized supply chains will benefit from the new reshoring trend. Select emerging markets. Countries benefiting from U.S.-China decoupling are already seeing investor attention and FDI inflows. Losers? That list includes multinationals heavily reliant on Chinese factories, luxury brands and retailers with global supply chains and shrinking profit margins, bonds, especially long-duration treasuries, which may remain under pressure as yields climb. Briefcase strategy for individual investors. If you're listening to this podcast in your car, on a jog, or during a break from work, you might be wondering, what should I do with my 401k? My Roth IRA? My kids' college savings fund? Here are 5 key strategies from senior analysts. Diversify globally. Consider adding non-US equity exposure, especially in Southeast Asia and India. Own real assets. A small allocation to gold or real estate can act as a hedge against inflation and currency weakness. Shorten duration. In bond portfolios, shift toward shorter duration bonds that are less sensitive to rising yields. Watch the Fed. Policy remains the key driver. Listen carefully for Powell's tone in future speeches and minutes. Stay liquid. In volatile markets, having dry powder, cash, or equivalents gives you options. United States. What this means for America. Now zooming back out to the national level. The U.S. still holds key advantages: a huge consumer market, deep capital pools, a culture of innovation, and military dominance. But those advantages mean little if investor confidence wavers. President Trump's China tariffs, for all their intention of bringing jobs home, have shown that economic isolation comes with costs. And when those costs erode trust in U.S. assets, the financial impact can be far more devastating than any battlefield. As one economist recently put it, America isn't losing a war, but it might be losing the benefit of the doubt. That's powerful. Because trust in markets, in currencies, in governments is everything. The dollar may bounce back. Treasuries might stabilize. But investors, both big and small, now know that policy risk is real, political risk is local no more, and the global economy is more interconnected and more fragile than we thought.